All right. So let's assume that, part of our wealth building blueprint is we got 3 different buckets of investments that we look at. We look at real estate, insurance-based products, stocks and bonds.
Yep.
Okay.
The big 3.
So, yeah. So, and, this is what I say. Some of the reasons that we utilize these is that, number one, these 3 types of assets have traditionally been able to provide cash flow for the household in some capacity. It provides guaranteed income. There are some tax benefits, and the capital appreciation does occur that generally will outpace the inflation rate. Now, I don't get that from all 3 from any one of those individually, but collectively, when you look at all 3 of those, you're
going to get all 3 of those. Yeah, you're going to get all those attributes.
Yeah,
you're not going to get each attribute from each one, but
right.
Yes,
because each one will have its own risk. So I think breaking that down is like, okay, well, that's probably a good place to start. Let's talk about the stocks and bonds. Now, would you just dump? Let's say we decided of the 300 or 400,000 left over, we're going to allocate $100,000 into stocks and bonds. And we're not giving investment advice right here. We're just giving a scenario here of things that we would look at. Would you just put it all in at once? Would you allocate it over a period of time? Like, what's your thought process right now on that?
100,000 is, while it's a lot of money, it's not a lot of money. I would lean towards the side of just invest it all at once.
Okay.
And look, I'm all for dipping our feet in the market and putting it in over a period of time. I mean, I do that with my clients every single day. But on 100,000, I'm probably just dropping it all in at once.
Yeah. Now, of course, we're going to ask, like, when is this money going to be needed as well? If this money is going to be needed.
There's 1,000,001 factors that are discussed before. This isn't like a across the board answer.
Correct. But most likely there is going to be some allocation to a stock and a bond portfolio of some mix. Yes. And that's going to be predicated upon what the person already has. It's going to be predicated upon how much risk they're already taking. It's going to be predicated upon how much tolerance for risk that they have.
Yeah, and there was actually a study, I think it was done by Vanguard, if I'm not mistaken. It came out earlier this year that lump sum investing, like dropping it all in at once, has actually outperformed dollar cost averaging, putting it in periodically. About 50% of the time. So it's a big toss up between the two. There's not a clear winner in the race. Yeah,
because no one has any idea what's going to happen the next 20 years.
Yeah.
Because it was probably I can see how that would be. You put a lump sum in 20 years ago, as opposed to dollar cost averaging, you definitely are going to come out ahead.
Yep.
Yeah. Because the markets have been pretty awesome for the 20 years. And you wouldn't have missed out on any of the upside at that point.
Yeah,
I can totally see why that would be. Now, is that going to be the case for the next 20 years, or is there going to be
I wish I knew.
That's what I'm saying. So I don't think there's a right or a wrong answer here. What are we trying to do here? We're just trying to create a scenario where this money is getting invested, is being put in an intelligent type of portfolio that is going to, provide an overall return that otherwise you're not going to get just sitting in cash.
Yep.
Simple as that. Okay. So then, okay, great. So then we're looking at insurance-based products. What are we looking at there?
Life insurance, annuities.
This is going to be dependent upon the person.
Yep.
This is definitely going to be dependent upon the person.
On their age, their health.
Yeah. So we would use a mixture of cash value life insurance and or an annuity contract. Now, why in the world would you do any of these things? Don't you know these things are just a ripoff, and that all you're doing is trying to make commissions, and the returns are going to be terrible, and the expenses are going to be, incredibly high? I mean, what kind of a fiduciary advisor are you, Gersh?
It's not all true. That is not true.
It's not?
Nope.
Dude, that's all I hear from fee-only advisors. That's it. So that disabused me of why in the world you're going to take people's hard-earned money and put them in these insurance contracts.
Well, let's beat up the
how dare you?
The commission aspect, because that's the most common that we hear.
Yeah.
Commission, right? And yeah, life insurance pays a commission. It pays a nice commission. I like it. And you do make more money initially off life insurance than you do putting it in a fee-based or fee-managed account.
Mm-hmm.
But over the next 20, 30 years, that life insurance pays that big commission up front and done. Whereas that fee account, let's say it's 1% of 100,000. It's $1,000 this year. Next year, if that account's worth 110, it's 1,100. 20 years from now, if that account's at 300,000, now it's 3,000 a year. So that fee creeps up, and that's not a bad thing. Look, I'm not here to knock either
just
commissions nor fees. I mean, financial professionals have to get paid for what we do. And neither commissions nor fees are inherently good or inherently bad. It's just, I guess, is the person who's earning them, is the advisor doing what's best for the client? And if that advisor is doing what's best for the client, I don't really care if it's called a commission or called a fee. At the end of the day, it's cost of doing business.
It's compensation of some kind.
Yeah.
Doesn't matter where you put your money. There's going to be a compensation that's paid to somebody for that. And the only difference between the insurance and and I guess the fee-based model or the fee model is that most of the commissions are paid relatively upfront. On cash value life insurance, it would be. And then there's no more paid out to the person, the agent. That's it. That's all they get. And unless you're putting some money in, there may be some trails.
Yeah, there's small trails.